Uh, the correlations. Why is it so important for these investors to have negatively or less correlated assets in their portfolio?
And there's an old saying in the financial or the quant industry that diversification is still free lunch. And I think that is something that I always try to have as my mantra. It's something I believe in quite a lot because obviously today, I mean, there's still a limited investable universe. There are only so many instruments, there are only so many strategies you can trade in, and everything tends to correlate to a certain extent. So it means that if you have a big enough portfolio that you need to invest, the key that you're always looking for is diversification, which obviously means that the new manager, the new strategy, the new program, or the new instrument that you want to invest in, you want it to correlate as little as possible with what you already. So that's of course why this correlation aspect becomes so important, because then obviously on a portfolio level, it means that you will have reduced volatility, you will reduce your drawdown typically, and of course increase your Sharpe. Of course, sometimes, if you're able to use leverage then as well, then it also of course means that you can boost up your overall investment in that because you're so much more confident in the strategy or the portfolio that you are managing. So that's why of course the information becomes key. I mean, even if you take our program on the systematic macro side, I mean, we run about 22 different sub-models in there at the bottom. And you can already say that, whenever we come up with a new factor or whenever we come up with a new model that we want to introduce sort of into the mix, I mean, we don't even have to look at the Sharpe ratio of that individual strategy anymore because it doesn't matter. If it has a high Sharpe ratio, it will most likely correlate with something in there anyway. So if we introduce it to the portfolio, it will have no effect. So it always becomes, the other extreme, but that as long as it's positive but negatively correlated, then you'll introduce with the portfolio. So it's correlation is important for a well diversified portfolio, and obviously the more diversified it gets, the more inflation costs.